Hey guys, so we had a great question from one of our students in the Commercial Real Estate Investing 101 course that I wanted to cover with a video because I think it's a great question that other people are going to have, and I want to make sure that the difference between these two concepts is clear to you guys. So the question was, what is the difference between the loan term and the amortization period? And this can be pretty tricky, especially if you're just used to 30-year fixed rate mortgages for single family home purchases, and now you're looking at buying a commercial real estate property. So I have an example of commercial real estate debt here. And what I have is a loan amount of $100,000, an amortization period of 30 years, and you'll notice that I have a loan term of 10 years. And what this is essentially saying is that the bank is willing to lend us money for a 10-year period. They want their money back in 10 years. So if we are to borrow money from them on January 1st, 2019, then they are going to expect that money back on January 1st, 2029. So the lender is only willing to lend their money for 10 years. However, the lender is also saying in this case, we will only give you money for 10 years. However, you can pay it off as if it were a 30-year mortgage. So what this does is it really smooths out the payments. So as you can see, we have a principal payment and interest payment that equal together $537 per month. And that's going to be continuous throughout every month of the loan term. However, this loan is being paid off as if it were a 30-year loan. So if we were to change the amortization to 10 years, then this loan payment would go up from $537 per month all the way up to $1,061 per month. So it's a huge, huge difference. So there's a really big benefit for investors to get an amortization period that is really as long as they can possibly get. So 30 years makes a lot of sense for a lot of investors. But what happens at the end of the loan term? So you're paying off the loan as if you had a 30-year loan, but you only have the money out for 10 years. So what happens? Well, this loan amortization table actually calculates that for us. So as you can see, we have something called a balloon payment here. And the balloon payment is the outstanding ending balance at the end of that 10-year term that you're going to have to pay back to the lender. So in this case, you've bought a commercial real estate property and you have these loan terms. What do your loan payments actually look like? Well, you're going to pay $537 each month, every single month for a 10-year period. So you'll pay $537 a month, but you're paying principal and interest every single month. So your loan balance is going down every single month, and you're only paying your principal and interest payment as though you were paying off the loan over a 30-year period. So now if you go down all the way to the end of year 10, which is going to be month 120, so right here, you'll see that at the end of month 120, we have an ending balance right here of $81,342. So in this case, if we are the borrower and we have a 10-year term on our loan, this is going to be our outstanding balance at the end of 10 years. So even though we've paid back principal every single month, we're still going to have this amount of principal that we're going to have to pay. And that's where our balloon payment comes in. So if we go back up to the top of the table, we have our balloon payment, which is that $831,342. So that's the amount that we're going to have to pay back to the lender at the end of 10 years. So think of the amortization period as the timetable that the lender says you can pay this off as if you were paying it off over this many years. However, we're only going to give you the money and allow you to borrow the money for the term, which in this case is 10 years. So at the end of 10 years, even though we gave you a lower payment each month, we're still going to expect our entire loan proceeds back in full. So I hope that was helpful in explaining the difference between the amortization period and the loan term in commercial real estate.